Horizontal analysis compares account balances and ratios over different time periods. It is an approach used to analyze financial statements by comparing specific financial for a certain accounting period with information from other periods. Now let's go to the problem. We have here the LenBong Manufacturing Corporation income statement. Now we are to compare the company's sales in 2020 and 2019. The analysis computes the percentage change in each income statement account at the far right. The first number we might consider is the change in profit. Net income increases by 8% considering internet and other expenses never increased by 1%. On the other hand, the sales increase was 6,351. The increase in sales has a bigger impact on the net income increases.
In this report, I will be discussing about LenBong Manufacturing Corporation profit and loss statement. As we can see in the figure, it shows the vertical analysis of LenBong's net sales as 100% and all other line items as a percentage of sales. The changes are generally shown in percentage. All the line items in a vertical analysis are compared with another line item on the same statement. In the case of an income statement, it is revenue or net sales. Looking at the profit and loss statement, we see that LenBong posted an increase in net income over the years of 7,460 in 2019, a net income of 8,087 in 2020, a net income of 8,767 in 2021, and a net income of 9,501 in 2022. Because of the increase in sales, net income also increases by 0.03% every year. Looking at the other components of the income statement, cost of goods sold increased by 45% even with this increase in cost of goods sold. Gross margin registered as 55% increase. Selling and administrative expenses showed a 32% increase. Despite this, income from operations recorded a 15% increase. The company's fluctuation in interest expense resulted in the increase in income before taxes despite the increase in net sales. Analyzing the components of the income statement, we were able to explain the increase in net income because of the increase in net sales. Hence, management can now understand that the magnanimous fluctuation in interest expense caused the increase or decrease in overall net income.
We use liquidity ratios to determine a company's ability to pay its current obligations and current operations. We have the results in the current ratio and asset test ratio or quick ratio. In the current ratio, its formula current assets over current liabilities and will test short-term debt paying ability. This ratio will tell us how much of our current assets can be used to pay every peso of your liabilities. As you can see, that the 4 succeeding years have resulted in a good current ratio. Why? It is because we see the progress of increasing current assets over current liabilities every year. Starting in the year 2019, it indicates that the current ratio resulted in 4.01, which means that 4.01 is to 1, or 4.01 over 1. What does this mean? So if the current ratio is 4.01 over 1, it means that for every 1 peso of the current liability, we have 4 pesos of the current asset to pay. Going forward in 2022 shows the highest debt paying ability as it resulted in 4.93. So we have 4 pesos and 93 cents to pay for every 1 peso of the current liability. Now, do we have enough current assets to pay LenBong Manufacturing Corporation? Yes. A ratio of 2.0 means that a company can cover its current liabilities 2 times over. A ratio of 3.0 would mean they could cover their current liabilities 3 times over, and so forth. On the other hand, if it is resulted in a ratio of less than 1, example 0.75, would imply that a company is not able to satisfy its current liabilities. In recommendation, although this is a good current ratio, we also need to exert more effort to collect more so that we have something stashed for minor or even major setbacks. Because remember, not all current assets can be used to pay its current liabilities. Next is the asset test ratio. This will measure the firm's ability to pay its short-term debts from its most liquid assets without having to rely on inventory or disregard current assets that are difficult to liquidate quickly, such as inventory. In general, the higher the ratio, the greater the company's liquidity. So starting in the year 2019, we noticed that this is a good ratio because it results in 2.13, which implies that the company owns 2 pesos of liquid assets to cover each 1 peso of current liabilities. Recommendation: it's important to note that an extremely high quick ratio, for example, a ratio of 10, is not considered favorable, as it may indicate that the company has excess cash that is not being wisely put to use growing its business. A very high ratio may also indicate that the company's accounts receivables are excessively high, and that may indicate collection problems.
The return on assets, or ROA, will measure the efficiency of the company in terms of generating income from the resources or assets it has. Based on the LenBong Manufacturing Corporation, the presentation shows the profitability performance from the years 2019 to 2022. As we can observe, from the year 2019, it has a percentage of 12.34%. For the year 2020, it has a percentage of 12.23%. For the year 2021, it has a percentage of 12.22% and 12.17% for the year 2022. Unfortunately, the result is decreasing. As we will compare these 4 consecutive years, starting from the year 2019 to 2020, it has a difference of 0.11%. Next, for the year 2020 to 2021, it has a difference of 0.01%. And for the year 2021 to 2022, it has a difference of 0.05%. So basically, they are falling. It means that our company might not be able to use the assets effectively to generate more income, or might because we have also trouble during our production. I have made a recommendation for our company in order to improve our sales. These are: first, we need to lower our expenses because there might be a possibility that our actual cost is higher than our budgeted cost, which cause us to lower our ROA. However, this might because we use expensive materials during our production. Next is we have to promote our product to the market. This will help in order to make our product known and get more customers. And lastly, we may also have an evaluation sheet for our customers that will indicate if they meet their needs or wants. Through this, our company will also know what need to improve on our product. That would be all. Thank you. God bless.
Good day. Here's the report for the balance sheet statement. As you can see on the chart, There has been an increase in the current assets and current liabilities this year by 0.5%. There was also no change in the long-term debt that resulted in the increase of the total liabilities. Moreover, the stockholders' equity has increased throughout the years. The findings in this report were as follows. The increase in the current assets was caused by the increase in both the receivables and inventories. There is also increase in the valuation of the fixed assets that contributed to the increase in the current assets. The increase in the stock price and market value of equity has made an impact in the stockholders' equity. The recommendations for this report are: the company should lessen its capital expenditures since the cost of capital is 12%, in which half of it were from the interest. Main reason why there is an increase in the accounts payable and accrued expense. Since there is an increase in the inventories, the company should slow down in the production of the goods. Based on the report, it seems that most of the sales were from the receivables. Therefore, it must be collected to increase the cash on hand. To lessen the liabilities, there must be a certain amount allocated to pay off the long-term debt every year. The excess in the inventories should be sold in cash, as this could contribute to the payment of the long-term debt. And that is all for the balance sheet statement. Thank you.